You bought SCHD for safe, steady income, but you look at your portfolio and it's flat. Meanwhile, the rest of the market is soaring. Most investors in this spot think their dividend fund is broken. So, is SCHD actually broken? Why has it stopped growing when tech stocks are hitting new highs? And most importantly, will it ever recover? In this video, we're going to answer those questions with hard data. I'm not just going to tell you that it's lagging. I'm going to show you the specific reasons why, but most importantly, I'll show you what lies ahead for the future. You know how gravity holds things down? That's what the Federal Reserve's interest rates are doing to SCHD's price right now. This is the single most important factor, and it works like a magnet. Imagine you have $1,000 to invest for income. For years, the safest option, a US Treasury bond, paid next to nothing. So, investors flocked to what they saw as the next best thing: stable, high dividend-paying stocks, often called bond proxies. These are the exact kinds of companies that fill an ETF like SCHD. But then, to fight inflation, the Federal Reserve aggressively hiked interest rates. Suddenly, those boring government bonds became very attractive. Right now, you can buy a government bond and get a guaranteed almost 5% yield, backed by the full faith and credit of the US government. It is essentially a risk-free return. Now let's look at SCHD. It's a basket of stocks. Even though they are stable blue-chip companies, it's still the stock market, which means you have principal risk. The value of your investment can and does go down. Think like a big money manager who needs to generate income for a pension fund. Why would you take on the extra risk of the stock market if you can get a fantastic, safe 5% return from a government bond? You wouldn't, unless the dividend fund offered you a better deal to make that risk worthwhile. This is the core of the problem. For SCHD to be attractive, its dividend yield has to stay competitive with that super safe 5% from bonds. The dividend yield is a simple formula: the annual dividend paid per share divided by the price per share. The actual dollar amount of the dividend is relatively fixed in the short term. So how can the yield go up to compete with bonds? The only way is for the stock price, the denominator in the equation, to go down or stay flat. The market has been doing this math for 2 years. It has effectively created a price ceiling on SCHD. It's not because the companies inside it are failing. It's because income investors have a safer, high-paying alternative. This gravitational pull is powerful and relentless. Until the Federal Reserve signals a clear and sustained path to lowering interest rates, this force will continue to suppress SCHD's price. The stock market has been a massive party for the last 2 years, but SCHD wasn't invited. Its own strict, disciplined rulebook is the very reason it's been sitting outside while the music is blasting. Let's look at the tale of 2 ETFs. The S&P 500, which you can own through a fund like VOO, has been on an absolute tear. Over the last 3 years, it delivered a staggering annualized return of plus 19.71%. This explosive growth in the S&P 500 wasn't spread out evenly. It was overwhelmingly driven by a handful of mega-cap tech stocks at the center of the artificial intelligence boom. Companies like NVIDIA, Microsoft, and Alphabet. These stocks became market darlings, attracting huge amounts of capital and pushing the entire index higher. Now, let's look at SCHD's rules for letting a company into its exclusive club. It's not a simple high-yield fund. It has a multi-step screening process. The first and most important rule is that a company must have paid a dividend for at least 10 consecutive years. After that, it filters for financial health, looking at metrics like free cash flow to total debt and return on equity. Think about what that means. Hyper-growth tech stocks like NVIDIA are in a race to dominate the future. They are reinvesting every spare dollar back into research, development, and expansion. They don't have a 10-year history of paying dividends, and they aren't trying to. Their goal is pure growth, not shareholder payouts. By its very design, SCHD's methodology automatically filters out the exact companies that have been responsible for the market's biggest gains. It's built to find mature, stable, financially sound companies that are already so successful they can afford to return cash to shareholders. It is engineered to avoid speculative growth rockets. This is a feature, not a flaw. But the result is a massive opportunity cost for investors who held SCHD instead of a broad market fund during this specific AI-driven period. While VOO rode the AI wave to new highs, SCHD stuck to its principles and got left behind. Stick with me, because at the end of this video, I'll reveal the one number based on Wall Street analyst targets that suggests how much SCHD could jump in the next 12 months if the market tide starts to turn. Even though the price looks sleepy on the outside, SCHD just went through a massive overhaul under the hood. The fund you own today is not the same fund you owned last year, and this is a critical point that most investors are missing. Every March, SCHD rebalances its portfolio based on its strict, unemotional, computer-driven rules. This isn't a fund manager making gut decisions. It's an algorithm executing a predefined strategy. This year, the algorithm kicked out 23 companies and added 23 new ones, resulting in a significant 20% portfolio turnover. Let's look at some key examples. The hot tech stock Broadcom was a top holding, but it was removed. Why? Not because it was a bad company, but because its stock price rallied so much from the AI hype that its dividend yield fell to just 1.2%. The algorithm looked at that low yield and said, "You are no longer a high dividend stock relative to the market. You're out." It also removed giants like Pfizer and BlackRock, likely because they failed to meet one of the stringent quality screens for financial health, like return on equity or cash flow to debt. So what did it add? It added classic consumer companies like the chocolate maker Hershey, and it made a huge strategic shift by dramatically ramping up its investment in major energy companies. ConocoPhillips and Texas Instruments were either added or had their weights increased so much that they vaulted into the fund's top 10 holdings. This reconstitution has fundamentally altered the fund's character. The biggest and most important change is that the energy sector is now SCHD's largest holding, making up nearly 20% of the entire portfolio. This means SCHD is now significantly more pro-cyclical. In simple terms, its performance is now heavily tied to the health of the global economy and the volatile price of oil. This is a massive departure from its historical reputation as a stable, defensive fund full of consumer staples and healthcare companies. This new heavy concentration in a single cyclical sector is a major risk factor that investors absolutely must be aware of. The fund is now more sensitive to geopolitical events, OPEC+ decisions, and the boom and bust cycles of the energy market. The sleep well at night quality of SCHD has been tempered. Managing your portfolio shouldn't be guesswork, but most brokers hide the full picture. They don't include dividends, they don't factor in currency changes, and they definitely don't make tax time easy. That's where ShareSite changes the game. It shows your true performance, tracks every dividend, gives you clear diversification reports, and makes tax reporting painless. And with my exclusive link in the description, you'll get 4 months free when you sign up for the annual plan. Start investing smarter today with ShareSite. So, with all these headwinds suppressed by interest rates, left out of the AI party, and now heavily tilted to volatile energy, is it time to give up and sell? Not so fast. Here's the bull case for SCHD and the specific scenarios that could signal its comeback. The argument for SCHD's recovery is based on two main ideas. First, market leadership is cyclical. The extreme, top-heavy outperformance of a few growth stocks won't last forever. History shows us that capital eventually rotates back to value stocks, the exact kind of high-quality, profitable companies that SCHD owns. It's a matter of when, not if. Patience is key. Second, and most critically, is a change in monetary policy. The primary headwind holding the fund down has been high interest rates. If the economy cools and the Federal Reserve begins to cut interest rates, the gravity effect reverses. Suddenly, that safe government bond might only yield 3% or 4%. In that world, SCHD's dividend yield of around 3.8% looks far more attractive, which could trigger a flood of new money into the fund, driving up its price. The expert consensus is that SCHD's methodology is still one of the best available. Morningstar has rated it one of the best dividend funds available, praising its sensible, transparent, and risk-conscious approach. Its recovery simply hinges on a shift in the market cycle. So what does that look like? There are 3 likely scenarios. Scenario A is a soft landing. The economy slows just enough for the Fed to cut rates without triggering a recession. This is the dream scenario for SCHD. Lower bond yields would make its dividend irresistible, likely leading to significant price appreciation. Scenario B is a strong economy with sticky inflation. In this case, the economy keeps humming along, which is good for the earnings of SCHD's new energy and industrial holdings. However, inflation stays high, forcing the Fed to keep rates elevated. Performance would likely be muted, caught in a tug-of-war between strong earnings and high interest rates. Scenario C is a recession. In a real economic downturn, SCHD would almost certainly still lose value. However, it would very likely outperform the broader market. The high-quality, financially sound companies it holds are built to weather storms better than speculative growth stocks. It would act as a defensive anchor, falling less than everything else. Now, for the number I promised you. A recent bottom-up analysis was done, looking at the consensus 12-month price targets from Wall Street analysts for every single stock held inside SCHD. This analysis found an average implied upside of 10.8% from its recent price. This suggests that on an individual stock-by-stock basis, the professional analyst community believes the companies in SCHD's portfolio are currently undervalued and have significant room to grow. So SCHD isn't dead. It's a high-quality fund being held down by interest rates and the AI hype train. Its recent shakeup adds a new cyclical risk with its big bet on energy, and its recovery likely hinges on the Fed cutting rates. If you found this data-driven breakdown helpful, subscribe for more no-nonsense investing analysis. Let me know in the comments, are you holding, buying, or selling SCHD?